Delta Corporation just recorded $1 billion in revenue, becoming the second listed company in Zimbabwe to record $1 billion, but they still can't meet demand.
Tell me how!
Well, to understand that, you would need to analyze the structure of the company, how it has got here, and where they are going next. I'm Kablaske Finance, and I'm on a mission to make passionate investors like you just 1% more informed. So, stick around, because the story is about to get quite interesting. Delta's origins on the stock markets date back to as long as 1946, back when it was called Rhodesian Breweries Limited, till now when it has become the biggest company on the Zimbabwe Stock Exchange. The company is currently split into 4 units: the Lager Beer division, responsible for brands like Zambezi, Castle Lager, and the biggest, Carling Black Label. The non-alcoholic beverages division, responsible for sparkling beverages like Coca-Cola, and the non-sparkling, non-alcoholic beverages like Mazoe, Minute Maid, and Bonaqua. Then there's a sorghum beer division that represents brands like Chibuku Super and Tabani in South Africa. And then on the wines and spirits division, that is under African distillers, we have brands like Viceroy, Whitestone, and Night Sky. Each unit contributes a fair share of revenue. But after dropping one of the biggest results in Zimbabwean corporate history, the CEO basically said, "We have ran out of capacity." That's not a crisis, that's a flex. Delta grew revenue 35% to over $1 billion. EBITDA jumped 42%, and then the beer demand is so strong they literally can't produce enough. Lager beer volumes up 19%, sorghum beer up 19%. Hitting the highest level since 1998. Think about that. Zimbabweans are drinking more Chibuku today than at any point in the last 28 years.
Jesus is Lord!
Now here is where it gets interesting. In a recent published article, Delta is reported to spend $120 million expanding production capacity. New brew houses, new packaging lines, major upgrades at Belmont and Southerton. This is not survival capex, this is we can't keep up with demand capex. And the balance sheet? Absolutely ridiculous. Net cash position $40.5 million. Debt to equity just 0.04 times. Return on equity 43.8%. That's world-class profitability. But there's a big risk nobody should ignore. Zimbra is chasing Delta for a possible $97 million tax bill. That's equal to 25% of shareholder equity and nearly 2/3 of the annual profit. If that fully crystallizes, it's going to be a massive hit. If they manage to settle lower, the stock will re-rate hard. Now let's talk about the real investment question. Is Delta still undervalued or is it overvalued? Here's my view. This is a supply-constrained market leader operating in a dollarizing economy with 94% USD revenue, strong pricing power, and a self-funded expansion cycle. That combination is extremely rare for Zimbabwe, but execution matters. The next 18 to 24 months will determine everything. Can Delta complete the expansion on time? Can shower margins recover? Can they settle the tax issue? And can Zambia and South Africa finally stop bleeding money? If management executes, this could become the strongest compounders in Zimbabwe for the next 10 years. But at the end of the day, what do you think? Is Delta a buy or is the tax risk too dangerous? Let me know in the comments, and as always, you're welcome.